key points to remember while preparing the financial statements. So initially I would look at the various business activities and how they are typically classified, or to simply put, the different classification of the business activities. You could look at three major categories. One is the operations activity of the business, which is more to do with the core business. For an automobile manufacturing company, the operations part is buying and selling the automobiles, buying the spare parts, assembling, and then preparing a finished product and selling it. So these kind of operations, these kind of activities related to the operations side activities. Then every company has investment related activities, majorly to do with buying and selling of the assets, buying and selling properties, plants, equipments, vehicles, or even investing in other companies. Buying the shares of other companies, buying the bonds of other issuers, all these things go as a part of investment activities of the company. Then we talk about financing activities, majorly to do with raising capital, right? Raising capital in the form of equity, debt, preferred stock, different modes of financing the activities, financing the business, and the payments towards the financing activities. So any company's business activities get divided into three major activities: operations, investment, and financing. So all these activities should be reported as a part of the financial statements. So all these three, there should be different kinds of mechanisms to report all these activities in the financial statements. There should be a mechanism for every activity to be reported. Nothing can be omitted. Every transaction needs to be reported in some form or the other in the financial statements. Right? So understanding of the different business activities and how they get represented in the financial statements is the core aspect of this particular session. So now that we know the various financial activities or financial major business activities of the firm, I am more interested in seeing what are the typical constituents or the elements of a financial statement. Right? Whenever we talk about the financial statements, what are the key constituents of that financial statements? One. And what are the key balancing parts of the financial statements? Are typically what is the accounting equation. So I want to look at the key accounting equation in this particular session. Also, I want to look at how the entries are typically made in the financial statements. The typical accounting process, wherein we would we would clearly discuss what is called as a double entry accounting system. So we'll try to understand that particular process, which actually is the basis for accounting records and finally the preparation of the financial statements. The concept of accruals in the scope of accounting, and what are the kind of adjustments that are typically being made for the financial statements. This is one more area. And the accounting system is something which we will try to understand here. When I say accounting system, the typical flow of information, right from the transaction entry on a day-to-day based transaction entry to the preparation of the financial statements. How are the various entries made at what point in time and how they finally translate into the financial statement? And finally, what is the care that has to be taken by the analysts in case they are using this financial statements for the valuation and the analysis of the securities? What are the key steps they need to look at if they are using this financial statements for evaluating the securities? So these are the key things that we are going to cover. So initially, starting off with understanding the key elements of the financial statements, key constituents of the financial statement. When I'm talking of key elements, as a part of the balance sheet, I find three key elements. One is the assets, two, the liabilities, and three, the owner's equity. Three major elements of the balance sheet or the statement of financial position. And then I see two major elements associated with the income statement. One is the revenue, two is the expenses. So these five are typically called as the elements of the financial statements. Now, within each of these elements, we see there are different kinds of accounts. Within assets, there are different kinds of accounts. Within liabilities, there are different kinds of accounts. And when I'm using the word accounts, these are those kind of records for where the transactions are typically recorded. So different kinds of headings under which the transactions are recorded, those are called as accounts. And for each account, there may or may not exist a contra account. When we say contra account, it's a negative adjustment to this particular account. So probably when I am looking at accounts receivable, means I've sold something to a customer on credit and he is yet to pay. So all these credit based transactions, credit based sales that have been done and the outstanding that is to be received, they are treated in an account called accounts receivable. So whenever a sales is being done on credit, we make sure that a corresponding entry is made in an accounts receivable account because we are yet to receive cash from that customer. But if I'm sensing at a later point that this amount will not be received, this amount will be a bad debt, then what I simply do is I adjust this accounts receivables account by the amount of bad debt, by the amount which I feel I may not be able to receive because of the default of the customer. So the bad debt is treated as a contra account to the accounts receivables account. So like this, we have different kinds of accounts under each of these under each of these elements of the financial statement, we find more than one account of different kinds under which the transactions are typically recorded. Now, a few of these accounts are grouped. A few of these accounts are typically grouped, and the group of accounts with a group heading is typically presented in the financial statement, which means the financial statement does not contain all the accounts, but it typically contains a group of accounts grouped with one unique name. So probably it's like there could be a group called inventory. But under this inventory, there could be various accounts. There could be a raw materials account. There could be a semi-finished goods account. There could be a finished goods account. There could be various accounts contributing to the inventory. But all these accounts are grouped together to form the inventory account in the balance sheet. So what we could see is, from an elements perspective, there are 5. Underneath each element there are a set of accounts, and each account is the header under which the transactions will be recorded, and each of these accounts can be grouped, and that group name is what is represented as a part of the balance sheet or the income statement. So the list of all these accounts without any kind of grouping is what we call as chart of accounts. It's like I'm having a big chart of all the accounts that are applicable to this particular firm, which means all these 5 of them will be grouped into one of these 5 elements. All these accounts are associated with one of these 5 elements, and are and may be grouped from the perspective of presentation in the financial statement, right? So now what we can do is we can try to understand each of these elements separately. Let's say assets. What are the key accounts that go as a part of the assets? So we have already discussed that assets are nothing but those resources which are owned and controlled by the firm. Right? All those resources which are owned and controlled by the firm, they all get treated as assets. Some of them, just to list: cash. Then we talk about cash equivalent, something that can be converted into cash within 90 days. 90 days securities, 90 days or below maturing securities are typically considered as cash equivalents. Then we talk about the accounts receivables. This is one more account, as we just now discussed: sales on credit and the amount yet to be collected. So that is considered as accounts receivables account. That is also an asset for the company. Then we can also look at inventory. Accounts receivables can have a contra account, as we just now discussed. A bad debt expense could be a contra account for accounts receivables. Then inventory, again, this is the kind of raw materials or work in progress or finished goods that are there with the company. Even this could have obsolete inventory as a contra account that could reduce the value of this inventory. I could also look at the prepaid expenses. Means expenses for which the cash payment has already happened, but the delivery but the good or service not yet received. Means it's like advance payment done, but the service or the good not yet received, which means that's an expense not for this period but for the next future periods. So which means today it's an asset because we have already paid for it. So it becomes an expense on a future date, but because the payment of it has already been done, even that is treated as an asset. Then the property, plant and equipment, all these things which are necessary for running the business, even the investments that have been typically made to purchase them, is going as a part of the asset because they are the ones which are owned by the company and controlled by the company. And